Hello everyone and welcome to This Week in the Markets. So this week market volatility surged as the FOMC minutes indicated discrepancy amongst officials regarding the quantitative easing program. Economic news in the US was mixed, but consumer confidence improved modestly in February. The G20 richest nations promised to refrain from currency intervention but did not impose strict steps to prevent it from happening. In response, the Reserve Bank of New Zealand also threatened to intervene in the currency market if the strength of the kiwi persisted. Now we'll take a closer look at this news in more details after our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So the biggest news event this week came from the FOMC minutes of the latest Fed rate decision meeting. Last month, there were chatters amongst officials regarding the end date for the Fed's supposedly open-ended quantitative easing program, which, unlike previous beliefs, is not tied to the unemployment rate going below 6.5% and inflation rate remaining below 2.5%. Investors were hoping that the January meeting minutes would offer some clarification, but it did anything but that. The Fed still could not come to a consensus on how long the quantitative easing program should last. However, there were an increasing number of officials voicing their concerns about the risk of ultra-loose monetary policies, and an emerging idea was to have the Fed regularly adjusting its size of the quantitative easing program each month, rather than buying a fixed $85 billion of mortgage. This has caused concern for the market as it suggests that the Fed could well slow down the purchases on the quantitative easing program, even before significant improvements in the economy. Given that the market has been rallying in a linear fashion for quite some time now, and that it is probably difficult to argue against the idea that much of the rally has been fueled by an abundance of liquidity as a result of the multiple quantitative easing program, we were perhaps not too surprised to see equity sell-off and US dollar rise on the notion that the quantitative easing program could be slowed or stopped prematurely, and it may continue to do so even in the short term. However, fundamentally, we don't think that much has changed even in light of the Fed's minutes. The reality is the Fed will only start tightening policies when they see strong momentum in the economy. And while the US economy is growing, it could not be classified as being strong yet. With the memories of the financial crisis still fresh in people's mind, we think the risk is more likely to skew towards acting too slowly rather than acting too quickly. That is, we don't think the Fed will take serious actions until there is substantial evidence of strong growth and inflation getting out of control. We still think that this gives rise to an environment for inflation trade where we are bullish on things like equities and commodities, but bearish on long-dated treasury bonds. Turning then to economic data, building permits in US came in at 925,000, 10,000 more than expected. Building permits show the number of permits released for new construction projects, and is usually a forward-looking indicator of future constructions in US. We see this chart that the construction industry has been recovering rather strongly in the last couple of years, which perhaps is one reason why some Fed officials have started to turn more hawkish. While housing starts also seems to be on an uptrend, its growth slowed this month to 890,000 from 973,000 last month. Unlike building permits, the housing starts numbers only tracks the new constructions of single-family homes or buildings, which makes it more specific and more volatile at the same time. So here we're content that at least the trend is still pointing higher. Now the Reuters and Michigan Consumer Confidence Index pointed higher in February also to 76.3, suggesting a recovering sentiment among consumers. However, this is just a first estimate, and just like we got an upward revision in January's estimate at the end of the month, we could possibly get a downward revision at the end of February as well, so we'll take this estimate with just a grain of salt at this stage. Now the G20 richest nation met over the weekend in Moscow to discuss challenges in the global economy. One of the main topics of discussion was the currency war, where central banks are competing to devalue their currencies to gain an upper hand in the global export industry. It was expected that Japan would be in the center of attention and criticism during this meeting, as its currency weakened over 20% with the new government. Surprisingly, Abe's government was not cited during the post-meeting communique, which merely said that governments will refrain from competitive devaluation. That gives the Abe's government more room to pursue the policies of their choice to tackle Japan's long deflation and continue to weaken the currency in the process. In New Zealand, the governor of the Reserve Bank, Mr. Graham Wheeler, sent the New Zealand dollar sharply lower on Wednesday as he commented on the significantly overvalued Kiwi dollar relative to the country's economic fundamentals. He followed these comments with threats of actually intervening in the exchange rate market to smooth out the peak and limit gains on the New Zealand dollar. Not only was this bearish for the Kiwi, it is also confusing as only just last week did the Finance Minister of New Zealand say that the government has no intention of intervening in the markets to weaken the currency. Our take is that Mr. Wheeler is doing just the classic jawboning to bring the currency lower in an attempt to soothe complaint from New Zealand's manufacturers and exporters who are hurt by the strong New Zealand dollar. We doubt any actions will be taken unless the New Zealand dollar rises above the 0.85 recent peak against the US dollar, and probably the government will wait until 86 or 87 before actually taking any solid actions. So here we think the downside risk on the New Zealand dollar should be limited despite the sharp decline on Wednesday. Although perhaps at the same time the upside would also be capped maybe around 86, 87 as with other currencies that hinted on government intervention these days, because market has an expectation that the government would step in and that will bring the currency down. And that's all for this week in the market. In the coming week, the first news to potentially move the market will probably be the Chinese HSBC Flash PMI, which will be released early on Monday, February 25th. Then we'll get a clearer picture of the housing market in US, with the new home sales and existing home sales figures being released on Tuesday and Wednesday, February 26 and 27 respectively. We'll take a look at these news and other news that move the market in more details next week. Until then, on behalf of the trading persistent, we wish you all profitable trading.